Hey everyone, thank you for tuning in for another video update. This video is being recorded Thursday in the early evening, June 2nd, 2016. As we start, let's take a look at the gold stocks and the daily candlestick charts. GDXJ is at the top, GDX on the bottom, and we show the 50-day moving average along with resistance in red and support in blue. And what we've seen happen in recent days, I would deem a bearish consolidation. Now, it's still possible that, we have the employment report coming out tomorrow. That's always a market mover. So, a positive reaction to that, you could see a pop higher in the metals and the miners. We should note the metals, gold especially. Gold has been really oversold. It's struggled to rally the last couple days, but it still probably has some room to rally. It was down something like 9 out of 11 days or 9 out of 10 days, something like that. So it's possible that we could get a little pop here before going lower, which I think ultimately is going to happen. And, you have the initial resistance there slightly above where the miners closed. It's possible they could close above it, but as I already said, I think if they show strength over the next day or 2 or 3 days, I think that's ultimately going to lead to more selling, and the probability is that they will break the 50-day moving average and then head lower towards those support targets of about 29 to 30 for GDXJ and 20.50 for GDX. Now, so far to the recent low that we saw a couple days ago, from the absolute top to the absolute low, the miners have corrected about 16% in GDXJ. Excuse me, 16% for GDX and 18% for GDXJ. So I think they're going to go lower. Who knows how long this correction will last in terms of price and time, but I think it's going to go a little bit lower. And moving on, let's get to the weekly chart, and we can see that, again, GDXJ at the top, GDX at the bottom. The moving average we use is the 80-week moving average. We've said this many times in the past, but notice how that great rebound we had in the summer 2014, where it looked like we were really going to break out, that's where the resistance held. Also, if you go back to 2012 and that great summer rally we had, the same thing happened. So, the fact that we moved way above that, it's a long-term positive in a new bull market. We've already mentioned that. But let's focus on the two support lines for each. Now, if you move to the lower of both those lines, in each case, that's about where the 50% retracement of the recent huge rebound is. So, when we're looking for support targets, you're looking for a number of different things. You're looking at moving averages. You're looking at, Fibonacci retracements. You're looking at the chart and looking for, areas that have been support or resistance in the past. So you look at all those things and come up with a possible strong target. And at least for the miners, if they do go lower here, I think I've outlined where the strong targets are. Another thing I did not put in for GDX, but you can also look at the 400, it just popped into my mind, but if you look at the 400-day exponential moving average, I'm getting a little off track here, but if you look at GDM, which I've showed in the past, and so we're talking about the senior gold stocks. If you look at the beginning of the bull market, 2001, 2002, 2003, it found support 2 or 3 times at the exponential 400-day moving average. Now, where is that right now for GDX? I think it's about in the low to mid 19. So the strongest confluence of support for GDX is, I would say, 20 or a little bit below, which is where the 50% retracement is. But, who knows? Who knows if it's going to bottom there? It might bottom at 21. It might bottom at 19. We just don't know. But, again, I'm going on a little bit too much, but you can see clearly if we go lower, these are where the strong targets are. Around 30 for GDXJ and around 20 for GDX. And if we move down to those lines, then the miners are going to be probably off more than 20% from their recent high. And look, in a bull market, that's when you want to be buying. You're best served in an uptrend to buy, especially in a volatile sector like this. You're best served to buy when something's 20 or 25% down. You're generally going to do well over time. Whereas if you chase strength when something's really overbought, it'll probably work out in the end, but you're going to have to wait longer for that to happen. Anyway, it's clear where support is. If we go down there, generally speaking, that's a buying opportunity. Now let's move on. This is the bull analog chart for our own customized junior gold index, which contains 18 stocks and currently has the median market cap is about 400 million in US dollars. That's a little bit less than 300 million if I'm right. If I'm wrong, well, let's just say 300 million US because it's easy for all of us to remember. Now, the difference between the two, and we're showing the 2001 to 2004 period in blue, and then the 2008 to early 2011 period, or middle 2011 period in red. And the difference between the two cyclical bull markets is pretty clear. I mean, interestingly, the after 2008, I mean, that recovery was pretty steady and gradual. I mean, it pretty much went almost straight up, but there were the corrections along the way were very swift and sharp. I mean, you see the 226% corrections, and at the beginning there was, in November there was like a double bottom, so you can't quite see that, but that was, I'm pretty sure that was 25 or 30%. And if you look at the corrections, which in red, which I did not annotate, I mean, those are probably in the 20 to 25% area. So there's a lot of those. Whereas if the 2001 to 2004, I mean, that fantastic period for gold stocks and for juniors, you basically had two really huge corrections and then some huge moves higher. Both the corrections lasted 5 months. One was 29%. That was the one in 2001. And then the one in 2002 was 53%. But of course, that was after a huge move. I mean, that was after that huge move higher into 2002. That was when the senior gold stocks, which I've pointed out in recent videos and charts. I mean, that was the most overbought the gold stocks have been in the last 25 years. And you could see at that point in time the juniors were up over nearly 6-fold in a short period of time. So that explains why there's a 53% decline. Now, how much are we going to decline right now? Well, looking at the technical analysis of my index, which I did in the last premium update, and I'm not showing it here, I was saying reasonably 33%, worst case scenario, probably 40%. So, if I had to guess, I'd say 33%, which is a 50% retracement. Note that I was talking about the 50% retracements in the other markets. So that's something to keep in mind. Now, this index, I think at the recent low was down 17% or so, although I have not updated it in the last couple days. So it's just something to keep in mind. I do think the correction that we're having now, I don't think it's going to be as short as the one the early one in 2008, where we were down 26% and we just went up immediately after that. I think at least this correction is probably going to last for most of the summer. And I mean, when is the next big move higher to new highs? When is that going to start? I don't know. I mean, it could be if this lasts 5 months like we saw happen in 2001 to 2002, then that would be October. Maybe it'll be September. Maybe it'll be the end of summer. But maybe it'll be October, even November. We just don't know. And hopefully we'll get a better idea of that as things go along. But like I said, looking for this correction to continue both in terms of price and time. And last, here is a chart that it doesn't really fit with my update, but I just updated this data a couple days ago, and it shows the put-call ratio for GDX. I used to show these quite often for GLD and SLV, and they were giving decent signals. Now, the one for GDX was not giving that great of signals, as you can see. I mean, if you look at the peaks in blue, that's the 20-day moving average of the put-call ratio. If you look at those peaks, they didn't really happen around important bottoms. But the one thing I want to point out here is note how the put call ratio has it went up to about 1.7, 1.8, and over the last 3 years it had never gone above 1.0. So we've had this huge move higher in the gold stocks, and it's a good sign that the put-call ratio has surged to a multi-year high. I mean, that's a sign of a lot of skepticism. Doesn't necessarily mean we're going to go down or go a lot higher from here immediately, but I just think in the big picture, it's nice that there's a healthy amount of skepticism there with respect to the rally that we've seen in the gold stocks, and that's what we want to see. We want to see skepticism. We don't want to see everybody being bullish. On that note, that's the end of the update. You can follow more of my work at thedailygold.com. You can opt into the box there where I'm giving away my book for free. Opt in and get that. I'd really encourage you to do so. Also, you can learn more about my premium service there at thedailygold.com/premium. And thank you all for tuning in. I really appreciate it. And I wish you prosperity and health and wealth. And I will see you again in the next week or two with another update.